It's almost 1 p.m. in Sydney and 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Asian stocks extending a global sell-off led by tech stocks. A mixed US jobs report adding to fears the Fed is behind the curve on rate cuts. China struggling to slay the deflation dragon as August consumer prices rise less than expected. Weak demand damaging the chances of hitting Beijing's growth target. Plus, Huawei set to ramp up the pressure on Apple in China, launching a trifold phone just hours after the debut of the iPhone 16. A lot of red on the screen around the Asia Pacific to start the week. Avril Hong's keeping an eye on markets in Singapore. Avril.
Yeah, Paul, so far it's a bad start. Asia's stock gauge slumping to the lowest level we've seen since the middle of last month. And of course, this tracks US stocks' performance last week, which was its worst showing since March 2023, following the disappointing US jobs report, and how that is raising all these economic jitters. Among the stock markets, we're seeing the tech-driven ones among the hardest hit. And we're seeing here how the South Korean Kospi, the Nikkei, the TAIEX deep in negative territory, particularly on Japan's benchmark. We saw it decline by about 3% earlier in the session. And this is against the backdrop of the moves that we've seen in dollar-yen hitting below the 142 level on Friday, although it's given up some of its gains. And this is after the Q2 GDP print was revised downwards, though some think it's still advanced enough to back the case for another BOJ rate hike this year. Now, we also got data out of China today, which just reinforced these deflation fears after CPI rose less than expected. Let's flip the board, take a look at what we're seeing in terms of futures pricing, because it was a really wild Friday. After the data dropped and comments from some of these Fed officials, we saw futures markets pricing in at 1.40% chance of a 50 basis point cut. Then it went to 70% and back down to 30 in a span of 3 hours. And this is against the backdrop of comments from the likes of Christopher Waller suggesting that 50 basis points is unlikely until we get more data in the coming months. We also had the likes of Janet Yellen seeming to suggest that the soft landing, that is still intact. Have a listen.
I believe that the balance of risk has shifted toward the employment side of our dual mandate, and that monetary policy needs to adjust accordingly. The current batch of data no longer requires patience. It requires action.
Overall, I would say for the U.S., the kinds of metrics that we would monitor that would summarize risks, whether it's asset valuations or the degree of leverage, things look good. There are not, I don't see red lights flashing.
Our next guest says the message from the U.S. payrolls is not good, and the trend in downward revisions is even worse. Let's bring in Simon Ree, founder of Tao of Trading. Simon, how bad exactly does the jobs picture look to you? Is it enough to warrant a 50 basis point rate cut?
Probably not the jobs data by itself, but if you look at the kind of the totality of economic data, the trend that we've seen over the last 12 months in the consumer, in housing, in employment, in manufacturing, looking at all of that, I think it does justify a 50 basis point cut. The jobs data was slightly disappointing. It didn't really swing the needle convincingly one way or the other for 25 versus 50. But the revisions have been very negative. You know, we've seen consistent negative revisions to that data for the last 18 months.
So do you see 50 basis points next week?
Look, I think they probably should, but I think they probably won't. I think a 50 basis point cut would be an admission that they're behind the curve. And you listen to what Wallace said on Friday, it looks like they want to take a very measured approach to this, and they're still looking for more evidence. So, yeah, markets pricing 25, I think that's probably what we'll get.
Well, we saw a pretty profound reaction from US markets off the back of that data, triggering some of the selling that was seen in the Asia Pacific today. I think global stocks saw the biggest wipeout in the past couple of weeks as well, in over 2 years. So it's a good time to get to our question of the day. Do you feel like global stocks are going to fall into a correction?
I think that's likely, Paul. What we're seeing is economic data is just continuing to trend in the wrong direction. You combine that with positioning in the equity market, particularly in sort of the techie and AI-related names, it's still crowded. One thing that surprised me during August, we had that big panic on the 5th of August, but subsequent to that, I was really quite surprised at just how quickly market participants went back to business as usual, aggressively buying the dip, and aggressively selling volatility again. So, you know, I think when you combine crowded positioning with the prospect of deteriorating economic conditions and a Federal Reserve that's behind the curve, the risks are certainly to the downside for stocks.
Yeah, where do you place the risk of a hard landing in the US now? Is bad news again?
Yeah, bad news is bad news. We're seeing that play out. And the other thing that we've seen in history is that the Fed cuts, and they cut aggressively during every economic downturn, but those cuts don't save the stock market. I mean, the stock market finds a floor eventually, of course, and those cuts will eventually put some sort of stability back into the economy. But the fact that the Fed is cutting and cutting aggressively isn't anything that's going to save the stock market if we do enter a recession.
Simon, you've also kind of looked back at things, I think, into the 90s. What does this data show us about how when the Fed cuts 50 at the start of easing cycle versus 25, and what that eventually means for the forward returns in the US stock market?
Yeah, it's a great question, Avril. If you look at, say, the last 5 cutting cycles, when the Fed began the cycle with a 25 basis point cut, the forward returns for the S&P were good. There were 2 cycles there where they began the cutting cycle with a 50 basis point cut, and the forward returns for the S&P 500 in those cases were dismal. Now, it's a small sample size, but I think there's some important causality there. The Fed only begins a cutting cycle with a 50 basis point cut if it sees stuff coming down the pike in the economy that the equity market will not like.
I want to talk about some of those numbers that we had out of Japan today as well. We had GDP accelerating a little bit slower than we expected for the second quarter. Do you think this is going to change the picture in any material way for the next move from the BOJ? Is tightening and tightening soon still the most likely outcome here?
Yeah, I think it is. I mean, Ueda's comments in that paper released to Parliament last week made it pretty clear that they still see room to hike. And I think unless the Nikkei has another heart attack, that'll be the path.
What about the yen carry unwind? I mean, a lot of the leveraged bets were wiped out or cleared out of the way last month during the crash. But
yeah.
Do you get a sense that, you know, it could get worse from here?
I think it could. I mean, we're seeing dollar yen kind of really plumb the August lows. And I think if we take those lows out, we could see another round of panic. At the very least, we could see expectation of more yen carry trade unwinds, which itself could drive weakness. And if we do see more forced selling, then we could see another panic.
What are the weak links, you think, if we see more panic?
Well, tech, really. I think tech and AI-related names were the most crowded coming into this, and the most overvalued. And I think positioning there is still fairly crowded.
And you're short NASDAQ, right?
That's right, yeah.
What about what you're long on?
So I'm long healthcare and utilities, and they've weathered this storm pretty well, as have defensives generally. But you know, if we do go through this soft patch, and this soft patch this growth scare becomes a recession, defensives will generally be a better place to hang out. And your more growthy sectors like tech and communications will generally bear the brunt of that, particularly given the crowded positioning and the valuations.
What's your approach to Japan more broadly at the moment? Because, you know, the Nikkei had a huge run-up, but now as we look to a stronger yen and that narrative likely becoming embedded, are you still a buyer of Japanese stocks, or is it just time to head for the exits more generally?
I don't have a strong view on Japan. I don't really feel as though I've got a strong edge being long or short that market. To me, I'm fairly neutral.
What about what you're seeing in terms of monetary policy in the US? Where is the neutral rate going to be, Simon?
Yeah, look, it's probably somewhere well south of where we are at the moment. I mean, these things like neutral rates and non-accelerating inflation rates of unemployment, they're very hypothetical. Is it 3%, 3.25, 2.5%? I don't know. yeah, it's probably at least 250 basis points lower than where we are at the moment.
What about when you look back at things? I mean, legacy-wise, what Powell kind of wants to leave behind. Do you think that in a way kind of informs what we're going to get in terms of monetary policy? Because when we started the hiking cycle, all these criticisms about them being behind the curve. On the other side of things, now that things are coming down, do you think, maybe that will influence decision-making?
Look, I think central banks are always behind the curve, and particularly when they keep saying that they're data-driven, because the data always lags. And so when they're making decisions after the fact based on lagged data, they're always going to be behind the curve.
Okay, Simon, stick around. We have many more questions for you. Simon Rhee, founder of Tao of Trading. Paul?
Right, still to come on Bloomberg Markets Asia, we'll discuss the outlook for India's wealth management industry. NeoWealth joins us later on this hour to talk about opportunities and risks for the sector. This is Bloomberg. China's consumer prices rose less than expected in August, while factory gate pricing remains stuck in deflation. It's just the latest sign of stubbornly weak consumption demand, adding to pressure on policymakers to hit Beijing's annual growth target of about 5%. Let's get more analysis on these readings now with Bloomberg economist Eric Zhu. Eric, another pretty weak set of numbers here. Where were the worst spots, and are policymakers going to be motivated to act?
Yeah, it's a not good reading. I think this morning's data, the headline is slightly up, but it's mostly driven by, the food prices, which is due to some temporary weather reasons. So if you look at the core CPI, which excludes food and energy, I think it's only 0.3%. That's probably, I think it's the weakest level in more than 3 years. So that's a very clear sign that how the demand is weak now in China.
Eric, amid all this data that just points to deflationary fears, a lack of demand in the economy, we're also getting some reports about how China is looking to fully open up manufacturing, healthcare to foreign money. I think, do you think this is going to move the needle?
At least not in the short term. I think if you talk about this year's growth target of 5%, if you talk about the near-term support to growth, I don't think that's the immediate recipe you can use. But still, it's a positive step. China is following through probably their commitment in the third plenum. They're committed to still opening up to the world. But we all know that the key hurdle now is not they're not allowed to enter, right? Probably the more important question, the key question is whether they're willing to enter, and is still China attractive to foreign investors. So I think policymakers need to at least address the short-term questions for this year. So are you going to still meet the 5% growth target? And given the so low demand, given the weak confidence, what kind of policies you can deliver immediately, trying to overturn the situation?
Yeah, what kind of policies can they deliver, Eric? I mean, the People's Bank of China's probably still got a little bit of scope for a rate cut there, but yeah. Do you anticipate anything targeted being announced to support factory prices? But judging by recent history, that's not really in the playbook right now.
We do expect PBOC will do more, probably more rate cuts, more triple R cuts in the rest of the year, given, the Fed is also expected to start easing. So that will relieve some pressure on the currency. But so far, we think, the steps which are taken by the PBOC is still too incremental, only 10 BP, 20 BP. So that's not, going to move the needle instantly. I think they do need, to consider bolder, bolder cuts or, even more measures in a broader sense. Yeah.
All right, Bloomberg economist Eric Chu, thanks so much. Now, Simon Ree, founder of Tao of Trading, is still with us. Let's get him to weigh in on what he's seeing in China. Just on the data today, we're just seeing these deflationary fears, anemic demand, lower than expected CPI reading, and then factory gate also deeper than expected in terms of the data. What is your sense of, how bad this looks, and why is it that stimulus is just not forthcoming?
Well, the Chinese domestic economy continues to look very weak, and consumers aren't spending, and they just refuse to spend, basically. Household income growth continues to decelerate. House prices are back at 2012 levels, and there is just a lack of desire for consumers to spend. And this is a large part of the weakness we're seeing in the Chinese economy. And I think people, global investors have been very frustrated at the lack of stimulus. Why haven't they kind of fired the bazooka? Potentially, Chinese policymakers are sort of getting a lot of what they want, and that is a reallocation of resources and investment into high-tech manufacturing. They've often repeated a stated goal to make China a global centre of influence in science and technology, and it's kind of helping them achieve that end.
Do you think perhaps that we might see more in the way of stimulus after some of the risks surrounding the US election are cleared up?
Well, China is leaning very hard on their export sector as well to try and drive growth. And of course, we've seen the US slap tariffs on things like electric vehicles and steel, and Canada followed suit with those tariffs as well. So we are kind of seeing, I guess, sides align. And I don't think, whilst Trump and Harris have got very divergent views on domestic economic policy, their views on foreign policy, particularly towards China, seem somewhat more aligned.
We've seen, Simon, some pretty hefty outflows when it comes to foreign direct investment in China. I think 15 billion in the second quarter, and that's the most since records began to get kept in 1998. So can you see this turning around under the current policy settings and the current geopolitical environment as well?
Look, I think it's tough. I don't understand what's going to turn that around given the current environment. I mean, China hasn't been the easiest place for foreign companies to make money, so the decline in foreign direct investment shouldn't come as a huge surprise. And let's face it, for most of that period, China was one of the strongest growing economies in the world, all right? And now its growth looks somewhat anemic, so that really lessens the appeal.
It's still, of course, a very large economy, second largest economy in the world, a lot of opportunities there, and a lot of assets are going cheap right now. Do you take a selective approach, and if so, what would you be looking at?
Yeah, look, I think you could take a selective approach, and yes, I think tech is a sector that stands out. It's a sector that's going to be, I think, a beneficiary of China's desire to become like I say, a global centre of influence in science and technology. So tech and healthcare would probably be good sectors. Sectors to avoid would be, I think, things like banks and manufacturing, basic manufacturing.
How long do you think it can lean on exports and manufacturing to drive growth?
Yeah, look, we're probably getting close to those limits, I would think. Particularly, if we do enter an even more protectionist regime in terms of global trade.
Why, though?
Well, if you're leaning more and more on the export sector, but the people you're exporting to are kind of less keen to buy from you, vis-a-vis tariffs and so forth, it makes that sector harder to grow. And certainly two of their biggest markets, being Europe and the US, are becoming less friendly towards Chinese imports.
What about when you look at the actual risks from tariffs? I mean, how do you see it potentially going beyond rhetoric to actual higher tariffs? I mean, you alluded to this a short while ago, but then eventually filtering through into actual hit to economic growth in China.
Well, it's a difficult question to answer because the tariffs are being implemented in a fairly targeted approach, all right? So EVs is obviously an industry that the US wants to protect, and so Chinese EVs, China's become the world's largest car exporter in the last 5 years. But it just depends whether this very, very targeted incremental approach becomes more wholesale. maybe a Trump presidency, that would be a risk. And maybe that's a smaller risk if the Democrats win.
All right, Simon, we'll leave it there for today. Thanks so much for coming in and sharing your thoughts with us. Simon Rhee, founder of Tao of Trading. Plenty more ahead. This is Bloomberg.
Here are some of the top corporate stories we're following. Westpac Banking has named Anthony Miller as its next CEO, succeeding Peter King, who's retiring after 30 years at the lender. Miller's currently head of the Business and Wealth Division. He's going to take the top job from December the 16th. The incoming CEO has been with Westpac since 2020, previously holding roles at Deutsche Bank and Goldman Sachs. Boeing and its largest union say they have reached a deal to potentially avoid a strike at the troubled US aircraft maker. The offer includes a 25% wage increase over 4 years and a commitment to build Boeing's next plane in Seattle. Breakthrough came after a marathon bargaining session, but it's too soon to know if workers will go along with the deal. The Nikkei is reporting that Mitsubishi Chemical is seeking to sell its pharmaceutical subsidiary, Mitsubishi Tanabe Pharma. The company is said to have hired a financial advisor and is sounding out possible buyers, including foreign investment funds. The report says the price could be above $3.5 billion. Let's take a look at how some of the commodities are moving today. We're seeing a lot of weakness in iron ore. It did briefly dip below that $90 per tonne level, putting on something of a recovery now, just hovering just above the $90 mark in Singapore at the moment. Dalian iron ore futures also softer. Taking a look at crude prices as well, they are rebounding. We've got Brent higher by about 1.3%. Horrible week for oil prices last week, but we've got crude now, as you see on the screen there, just below $72 for Brent. That notwithstanding, Morgan Stanley has reduced its Brent crude price forecast for the second time in just as many weeks. The global benchmark sees now having an average of $75 per barrel in the fourth quarter. This is according to a recent note from Morgan Stanley. So Brent recently falling to its lowest level since 2021. There you see on your screen some of the big Asian petrochemical stocks. CNOOC at the moment off by almost 5%. PetroChina softer as well by 5.3%. Generally speaking, though, we're seeing a lot of weakness around markets in the Asia-Pacific today. All of the major benchmarks are sliding. We've got the Nikkei off by more than 2% at the moment. We also have a stronger yen, 142.86 versus the dollar. And we're watching the Aussie yen cross as well. The Aussie strengthening against the yen now above 95 cents. Still to come, we will check Apple suppliers as Huawei prepares to launch new products just hours after Apple's debut of the iPhone 16. We'll have a preview of that next. This is Bloomberg. Welcome back. China markets just heading to lunch. Pretty weak session for Chinese equities at the moment. The CSI 300 now off by more than 1%. We had some fairly wretched data out of China earlier. PPI contracting 1.8%. Producer prices have been in deflation now since late 2022. CPI wasn't a lot better, accelerating 0.6%. There was an improvement on July, but also a miss, Avril.
Indeed, and as we digest some of that data out of Asia's largest economy, let's also check in on how markets in Japan are faring as we're about to come back from the lunch break. It has been a deeply negative day for Asia equities, with Japan leading the sell-off. We saw the Nikkei earlier in the session declining about 3%. Similar losses on the topics. Coming back from the lunch break, they are still showing declines of about 2% each. And indeed, on the broad-based gauge, it's all the 33 groups that are in negative territory today. Of course, we are also seeing a bit of a headwind for Japanese equities in the form of the Japanese yen, as the data from last Friday out of the US really prompted that rally in the yen below the 142 level against the greenback. It's given up some of those gains since after data today, which show the Q2 GDP out of Japan a downward revision there, though most still seem to think that it has advanced enough to back the case for another BOJ rate hike this year. Now, we are also keeping a close watch on some of the Japanese firms, including 7&i, which last week rejected the overtures of Canadian firm couche-tard. Couche-tard today saying that, it's going to talk. It wants to push for talks with the Japanese convenience store giant, and it's still looking for a friendly takeover. Of course, 7&i rejected the takeover proposal because it saw it as too low. Now, markets are in a sell-off mode. Let's bring in Bloomberg MLive strategist Mark Cranfield for a deeper look at where things go from here. We are seeing a heavy sell-off. You're looking at some of these indicators, including the Aussie yen, which suggests things could get worse from here, maybe?
Yeah, I think people who've got long memories in Asian markets especially, they don't like the look of this at all, because if you think back to the global financial crisis that was kicked off with Lehman Brothers going bust, the singular trade that macro traders put on really across all kinds of asset classes was to sell Aussie yen. It had an almost perfect correlation with falling equity markets around the world. We're beginning to see stages of that again. It started early in August as the Japanese market started to crumble. We saw people start using Aussie yen to sell Aussie yen again as a way to hedge against equity market risk. It's early stages yet. It's nothing like as extreme as it was back in 2008. But clearly it's a warning signal that if we get into the same kind of scenario where people are looking for the big hedges against financial markets, and it's very interesting that the yen this time is getting some haven status again, as it did back in the financial crisis. So those parallels are not comfortable for people looking about equity markets in the near term. They're probably thinking there could be worse to come.
You called this as well, right? You said regardless of what we get out of the US jobs data, we would see a strengthening in the yen. What are the dynamics at play here?
We've got a disconnect between what investors are seeing and where the central banks are, especially the Federal Reserve. So if you think of the narrative coming out of the markets is they're beginning to see a hard landing scenario. They're seeing the data from a very negative point of view. Even though the employment data which came out on Friday was pretty close to being in line, unemployment rate actually dipped back to 4.2%. It was the previous one, 4.3%, which sparked a lot of angst in the markets. But here we are, the data wasn't too bad. But soon afterwards, we had Federal Reserve speakers commenting. Now, the investors were looking for an endorsement that a 50 basis points rate hike was coming in September. They didn't get it. They got a much more ambiguous outlook from those Fed speakers, and that to them was disappointing. So here you have markets priced for something like 200 basis points of rate cuts. Fed speakers not yet endorsing that. At the same time, the yen is re-establishing some haven status as well. So dollar yen is your obvious point of pain, really, for everybody to reflect that, because at the same time, the Bank of Japan clearly is moving towards another tightening. Might not be in September, might be delayed till later in the year, but that is obviously on the table. And it didn't help that the former BOJ Governor Kuroda came out and said that the neutral rate for Japan is way above where it is now. Now, thank you, Mr. Kuroda, because that is something that he probably feels the shackles are off now. He doesn't have to be politically correct anymore, and he can say what he really thinks, and the markets didn't like it.
And probably also complicating things inadvertently for his successor. But when you look at the soft landing, hard landing argument, I think that's really what underscores what lively debate we might get next week. What do you think we will likely get in terms of cuts?
Personally, I think the Fed will go 50 basis points. I think they're beginning to see that it could have been a mistake not going in July. There was a window for them there. The data was starting to point that way. I think if they'd gone early with 25 basis points in July, we wouldn't even be having this conversation. People would think that the Fed's going to do a long series of 25s. Everybody would be on the same page. They didn't. In the meantime, investors are convinced that the economy is slowing more quickly. that the Fed is well behind the curve. We have the US elections coming up, which complicates things because the Fed have a meeting near the elections in November. They have another one in December. They may well put themselves in a position where they feel it's better to do a larger cut first, get it out the way, and then maybe they can proceed with more normal cuts after that. So if I had to put money on it, I would suggest I'll go for the larger cut in this month.
That is so interesting. In the meantime, we have data today out of China, and on the face of it, it's not telling us anything that we don't already know about deflation, about how it's leaning on, the export side of things. What is your sense of whether we can even look to a turnaround at some point?
It's a drip feed of consistently negative news coming out of China. There needs to be a circuit breaker. There needs to be something that tells investors that this continuous bad news, underperforming economic numbers, people downgrading GDP outlooks, all this kind of thing, it needs to come to the point where either the Chinese authorities step in and do something very aggressive that makes investors feel, okay, this is the turning point, or we see something in the property sales numbers improve a lot, or secondary numbers improve in terms of housing pricing, or we see something in terms of fantastic earnings, which again wasn't the result. The most recent earnings numbers were pretty disappointing as well. There needs to be something to tell investors they are wrong to keep on selling Chinese equities. For the time being, all that's coming out is just endorsing this story that there is no, and if you look at things like that, H shares futures is a very good indicator of whether dip buying is serious or not. And it's just suggesting that month after month, people are just ignoring, they're moving away from that market. The volumes are getting lower, open interest is getting lower. It means that people are not buying the dip there. They're not encouraged to. They need to come back, or else the market will continue to fall.
Looks like we'll see more of the same for some time to come. Mark, always great to chat with you. Thank you so much for coming in and sharing your analysis. Bloomberg and Live strategist Mark Cranfield. Paul?
All right, thanks, Avril. Let's take a look at how chip stocks are doing around the Asia-Pacific at the moment. It is, of course, very much a down day for markets. More broadly, we have the Nikkei off by about 1.7% right now. The Kospi weaker by 0.75%. We're keeping an eye on Apple's supplies as well, because we are expecting to hear from Apple later on today, US time. One of the most important events of the year. The company's going to be rolling out its latest iPhones, perhaps setting the stage for a new artificial intelligence platform as well. There's a lot of anticipation around the iPhone 16 in terms of this being a very meaningful update. The theme for the event, it's glow time. And that is a reference to Siri's new interface. Sticking with Apple, let's bring in our tech reporter Annabelle Drewlers for more on that device launch later on today. Annabelle, we've got a few ideas of what might be coming. What more do we know?
Yeah, well, Paul, I was just thinking it might be glow time, but it is certainly not go time by the sounds of it, because really we had so much anticipation that Apple's latest iPhones could set off a sort of upgrade super cycle. That doesn't really seem to be happening. So later today we're going to get the latest iPhone 16 lineup. You've got the base model, Pro, Plus, Pro Max as well, I should mention. Again, a lot of expectations around this, but when it boils down to it, we're really not seeing very many changes. So the devices themselves should look largely the same. Yes, you might get one or two models that has a larger screen. You'll get new colors coming out, of course. There's going to be this new action button. That was a feature that was on the Pro version in the past. That could be now made across the lineup. A lot of different details to that, but the main thing to know is that it replaced the mute switch. Speaking of buttons, we could also see a new one to help with taking photos. But again, these are just really incremental changes. On the software side, we're looking at this integration of Apple Intelligence. So AI features for the first time is going to be rolled out. But dial back the expectations here, because, again, earlier this year we had Apple unveiling this software to the market. It seems like the actual integration of it is so far going to be quite limited. And so, again, it stops people from upgrading this time around.
Belle, we mentioned some of Apple's suppliers in Asia. Which ones are you watching in particular?
Yeah, well, even with incremental upgrades to the iPhone, there are still some suppliers that do stand to benefit more than others in this market. So, for instance, on the camera front, we could see more megapixels coming through, better zoom capabilities, and so that benefits two different suppliers. Largan and Sunny Optical. Again, they've got different but specialised advantages in this space, is what our Bloomberg intelligence team is saying. They're also looking at the assembler side. So, for instance, of course, we think about Honhai or Foxconn as the largest assembler of Apple iPhones. There's been another that could actually take second position later this year. That's Luxshare. They've actually been continuing to gain their dominance in the market, so they shouldn't have any troubles, for instance, posting double-digit gains this year. And then as well, LG Display. Now, we have seen that focus on the screen enhancements. Again, Apple is really pushing through with a policy to try and diversify its different supply base. That's at the detriment of Samsung Display. It is at the benefit of LG Display instead. So they're just some of the names we're watching later today.
So we're also hearing Chinese tech giant Huawei is going to be unveiling a new smartphone not long after Apple. What's in store there?
Well, Paul, it really seems like the timing on this launch, it's not by mistake. That's what I would say. They're really going head-to-head with Apple yet again. So the focus today, the device, it's going to be this smartphone. You're seeing here some images that were posted to Weibo by the company earlier this year. But we're hearing that it could be a device that's folded 3 times, a tri-fold phone instead. We're kind of used to that idea of a phone that can fold twice, but 3 times. It's all about having bigger screens or bigger screen size fitting into a smartphone device. Again, it's really trying to push ahead with that very intense smartphone rivalry that we see in China. We had seen Huawei gaining ground. We do see customers perhaps turning a bit more back to Apple, so it's quite an interesting dynamic to watch. But that is one of the key focuses of the Apple or Huawei event later today. And also as well, do we get any sort of announcements around semiconductors? Because we will be hearing from Huawei semiconductor division. And again, very intense competition. Huawei has been trying to push ahead and create a device or chip that can mirror or rival what we hear or what we get from NVIDIA.
All right, Annabelle Drill is there in Hong Kong. And you can read more about Apple and its rise to become the world's most valuable company on today's Big Take. Subscribers can read that story in full on the terminal and on Bloomberg.com. Still to come, Neo Wealth Management joins us to discuss the evolution of the non-bank market in India and the guardrails needed to protect it from systemic risk. Our India focus up next. This is Bloomberg. We're just under a minute away from the open of markets in India. You can see there in the pre-market, though, a little bit of weakness there, although Nifty 50 futures are modestly positive. That would buck the broader trend that we're seeing around the region at the moment. Pretty much a risk-off day. Well, a large portion of India's non-banking financial companies, or NBFCs, rely on borrowing from banks to fund their operations, and this makes them highly vulnerable to any liquidity issues within the banking sector and poses a problem for India's regulators. So let's discuss this further with Hina Kamra, MD of Neo Wealth Management, one of India's fastest growing investment management companies. Hina, thanks for joining us today. We're certainly seeing a rapid evolution in the availability of wealth services, financial services, credit as well in India. What are some of the key changes that you're seeing in this space?
Well, India seems to be, in a very good place on the structural side. We have democratization of credit, democratization of wealth, expanding economy, all happening at the same time. So the things are good, everything is going well, but the key thing that needs to be tracked is that both banks and non-banks, which includes not just the NBFCs, but it's the entire non-banking financial intermediation space, which includes AIFs, mutual funds, pension funds, insurance funds, all put together, they're becoming very large and meaningful, and they are interconnected. But interconnectivity is not bad. It is actually a very complementary and symbiotic relationship where, banks mobilize retail deposits and take care of the traditional credit, whereas the non-banks cater to other parts of the segment. It could be the weaker sections of the society. It could be more specific investment themes like the equity markets, real estate funds, infra funds, distressed credits, and so on and so forth. But there is an interplay, which I think the regulator has been tracking very, very carefully. The guardrails are in place because the trackers are in place. And NBFCs, if we just talk about NBFCs, you have a capital adequacy of 26%. Yes, there are hotspots, but I think the regulator is taking care of those. So no cause for concern as of now.
Hina, we're also hearing about how some of these banks have their core technology, the worry surrounding it being a bit outdated. What is your sense of this, given, how you're leading this new wealth firm?
Well, technology and the disruptions that it can cause to the existing business models is a reality today and no longer a subject matter for debate. Having said that, we are a relatively new firm, hardly 30 months into operation. So we do not really face the challenges that come from legacy issues and legacy technologies. What we are doing is that since we have the freedom to build our technology the way our business model warrants, we are ensuring that it is integrated into the workplace throughout the year. And also, we're not just leaving it to the CTO or just by hiring tech-savvy talent at mid and junior level. We are actually training both the senior management as well as the business heads so that this becomes far more effective.
More broadly, we're also seeing how there's a lot of exuberance in India's markets. How would you say this compares to past cycles?
If you look at the Indian markets, and I think 1990s post-liberalization is when we should be tracking it, you've had 4 major bull runs. One was the early 1990s. Then you had the 2003 to 2007 period. And then there was, of course, the post-GFC crisis, and now the post-COVID. But no two cycles are alike, so you really can't compare apple with apple. Having said that, there are a few learnings which are there. No cycle is one way, whether it's an upswing or a downswing. Just the shape of the curve is different. Second, in times of bull run, there are excesses that happen. There is FOMO, and there is a risk off, which leads to some kind of a systemic risk. And in bear runs, exactly the opposite happens. So if you look at the Indian markets right now, I think what I would suggest is that all investors need to have a very holistic asset allocation strategy instead of just getting biased towards equity. Having said that, I think there are a lot of positive triggers. Your GDP has been revised upward by RBI to 7.2%. Private capex is in its nascent stage. NPAs are at multi-decadal lows. Yes, market cap to GDP factor is slightly peakish and warrants a pause till PAT numbers actually catch up. But there is room for movement in the large caps. They still look good.
Mm-hmm. Hina, in your prior role, you saw both a rise and a fall in real estate investing in the country. I'm just wondering if you could give us some insight into that. What do you make of the current increase in real estate investments that we're seeing?
Well, real estate prices are increasing. Real estate investments are also increasing. So there is an upswing on both sides. But let us acknowledge, a fair bit of it is also because of the wealth effect that is created by the bullish sentiment in the equity markets. So not all of it is end user demand. Now, having said that, structurally in the last 7 years, since 2017 actually, a lot has changed in Indian real estate. It started with RERA, then came the digitization of land records, REIT issuances, and emergence of new asset classes besides residential and commercial in the form of data centers, logistics, industrials, etc. Also, we find that there is a lot of transparency that is there in the system today and a lot of data availability. All this is giving a lot of comfort both to retail and institutional investors like never before. In fact, the institutional market is actually deepening over here. You have a lot of new players who are coming into the market, and the old players are actually increasing their exposures.
All right, Hina, thank you so much for joining us. Hina Kamra, MD of Neo Wealth Management there. Let's take a look at how the Indian markets are tracking a couple of minutes into the open now. Seeing a little bit of weakness, not too bad considering some of the risk-off sentiment that we're seeing around the rest of the region. The Sensex there off by about 0.1%, and the Nifty Bank Index off by a similar amount. We have plenty more ahead. This is Bloomberg. Here are some of the top geopolitical stories that we're following. Republican presidential nominee Donald Trump leads Democratic contender Kamala Harris by 1 percentage point in a poll taken late last week. The New York Times Siena College survey has Trump at 48% to 47% for the vice president. Meanwhile, Trump says countries that trade with currencies other than the dollar will not do business with the US if he wins office again and would face 100% tariffs on their goods. Venezuelan opposition leader Edmundo Gonzalez has been granted political asylum in Spain after fleeing his homeland to avoid arrest. It comes a month after the opposition presented voting records they say prove Gonzalez won the July 28 presidential election. But Venezuelan authorities said Nicolas Maduro was re-elected to a third term and ordered the opposition candidate's arrest. A gunman has killed 3 Israelis at a terminal on Jordan's border with the West Bank, the first such incident since the war in Gaza began. Israel's army says the gunman accessed a bridge crossing from the Jordanian side in a truck and fired shots before he was killed. The victims were identified as forklift operators over the age of 50. Israel closed the crossing while checking the truck for explosives. Let's take a look at how markets are doing at the moment. We're focused on chip stocks. Of course, it was the tech sector that bore the brunt of the selling in the US on the back of that rather confusing non-farms payroll report. We've also got Samsung Electronics sliding after KB Securities and CLSA downgraded their price targets. Well, that is it from Bloomberg Markets Asia. Horizons in Middle East and Africa up next. This is Bloomberg.